What's up, everyone? What is going on with the stock market? As we're in the middle of earnings season, companies are reporting historically high earnings, but why are the stocks selling off? In this video, I will share with you some data that will help you understand why earnings are up but share prices are down, and how to navigate the market in order to grow your portfolio. I will end the video giving you my top 3 sectors and some stocks that I think will do well for the next 3 to 6 months as we head into a potential higher inflation and interest rates period. So stick around. Swadee Cup, that's hello in Thai. My name is Anthony and welcome to Quantum Finance. I'm a former engineer in data analytics turned entrepreneur and investor. I'm now making YouTube videos part-time to help others make lots of moolahs. If you find the video content of value, please help us grow our channel by liking and sharing the video. If you have not already subscribed, please do so, and while you're at it, please hit the alert bell button so you can get my latest video update. Also, if you would like to get 2 free stocks valued up to $1,850 each, be sure to use my link below in the description to open an account and deposit $100. As an affiliate, I will be receiving 1 free stock, and this will help the channel out. So, some of our viewers have received Tesla and Google stock. If you like to follow what I'm trading and investing in, you can support and join the Quantum Finance Patreon by clicking on the link provided in the description section or in the comment section below. I do provide a weekly watch list with suggested entry and exit price points, support and resistance level, and a probability rate. Please note that this video is for pure entertainment and educational only. I am not a licensed financial advisor. With that out of the way, let's get right into it. The Factset Earnings Insight is a weekly report where Wall Street analysts survey S&P 500 companies on the estimated and measured against the actual earnings report. You can Google search it by typing Factset Earnings Insight and download the PDF file for free, or you can click on the link I have provided below in the description section. As of April 23, 2021, there are about 25% of the companies in the S&P 500 that have reported their Q1 2021 actual earnings result. It is estimated that close to 50% of the S&P companies have already reported their earnings as of Friday. In any case, about 84% of those S&P 500 companies have reported a positive EPS surprise, and 77% of those companies have reported a positive revenue surprise. Once we get more earnings report data, it is estimated that the 84% rate will likely to increase to 87 to 88%. If this 84% is the final data, this marks the highest percentage of S&P 500 companies reporting a positive EPS surprise since Factsheet began tracking its metric in 2008. On average, the earnings growth rate for the S&P 500 is 33.8%. It is estimated that it will more likely be around 46% as of Friday. They're predicting that the growth will continue into Q2 and throughout the year. Despite the off year of 2020 due to the pandemic, these numbers are indicating that 2021 earnings are on track to be higher than the year before the pandemic. This has real implication for stocks. This chart shows the historical and estimate EPS from 2011 to 2022. As you can see, the estimate are showing amazing projected growth for 2021 and 2022 to be much higher than the pre-pandemic year of 2019. I'm using 2019 as a base since some of the quants may argue that 2020 was an outlier year, which it is. You can see the big drop in 2020 from $163.12 down to $140.46 per earnings per share. So for 2021, it is estimated earnings per share of $180.13 compared to $163.12 in 2019, or a 10% growth. Now, for 2022, it is estimated that it will be about $204.17 versus $163.12 in 2019, or a whopping 25% growth. Note that on average, 77% of the S&P 500 companies beat their earnings report, so the probability is pretty high. If I show you this chart, you'll see that the share price and the earnings per share, or EPS, have diverged in 2020. Basically, the share price has gotten ahead of itself, or being front-loaded. I realize that the short-term market is reacting to inflation fear and the potential tax rate hike. So some analysts are saying that we're in a bubble and is about to burst. Yes, we have to pay attention to the market sentiment to gauge how much investors are willing to pay for the stock price, etc. Right now, for the short term, the enthusiasm is not as high compared to 2020. But for the long-term earnings growth and expectation, there's a strong support that the market will go higher. So far, the earnings report have been great and expectation for this year is very good. So I don't want you to be too bearish about the market going forward. But why are the stocks flat or down? Well, for the month of April, the S&P 500 generated a 5.2% return, which is the best month since November 2020. But we're seeing a huge disparity in stocks, especially in the past couple weeks, as most stocks have been front-loaded. Since the earnings report came out, a lot of the stocks have actually not done well. For instance, a lot of the social media companies fell hard despite strong earnings in fear that when people get vaccinated, there'll be less people spending their time on the platform as they'll go outside and do other activities. The only company that seems to have done real well are Facebook and Google due to advertisement increase. Another example is Tesla. Its stock was down 4.5% on earnings. This is after the fact that Tesla grew its earnings by 304% and its sales grew by 74%. The issue for Tesla is that it had 101 million profits in Bitcoin and 500 million in regulatory credit sales. Now, Tesla only makes electric vehicles and they have excess emission regulatory credits and they sold it to other ICE companies for profit. This caused investors to worry that Tesla may not be growing its core business as much as expected, and that these revenue from Bitcoin is a one-time deal and regulatory credit sales may dwindle in the future. However, on Friday, it gained back its losses. The same thing happened for NIO. Going into its earnings, the stock was actually down because there was the fear of semiconductor shortages in Q2 and beyond, and that it will incur additional upcoming expenditure, therefore dampening its profit. However, on Friday, it did gain back its losses. Moving forward though, I do think that NIO will be doing real well because it's well positioned for the growth in the future, and it will be able to capitalize its growth as it expands into Europe, grow its power swapping station throughout China, building its 1 million vehicle factory in the NIO Park, etc. So if you notice that a lot of the stocks are down, it has to do with the forward guidance outlook that investors pay more attention to than the actual earnings for that quarter. As mentioned earlier, the fear of inflation will cause companies to raise the price, making it more expensive for customers to buy. The commodity prices of the raw materials such as copper, corn, etc. that goes into production of goods have more than doubled or tripled since last year. Essentially, with inflation, companies are passing on the cost to the consumers. This is a big fear in the market right now, as people will be able to buy less and therefore slowing down the economy. So most companies have issued statements that they will increase prices. For instance, Whirlpool announced that they'll hike by as much as 12%. Coca-Cola and Procter & Gamble have also announced price increase in the coming months. So in the next few weeks, we'll see a potential report on consumer price index or CPI data, inflation data, etc. because normally these data tend to lag a little bit. So what investors will pay attention to is if those companies will absorb the commodity price increase. If that's the case, it will lower the company's profit. But if they pass it on to the consumer, it usually translates to high profits, but the effect also lowers the CPI, and this could have a shock in the economy. So right now, the inflation and the interest rate fear are hurting the high-tech, high-growth, and emerging market companies. Investors have rotated out of these sectors and into energy and financial since November. But these two sectors have also slowed down. Again, investors have bid it up and have front-loaded it. Having said that, the market is looking for new leadership, and I think it will be in the industrial and material segment of the market. Example stocks are in big equipment and big manufacturing such as Boeing Company, John Deere Company, General Electric, and the airlines. Now for the material stocks, I'm thinking the miner of the copper such as Freeport, McMoran, lithium such as Albemarle Corp, fertilizers such as Mosaic, chemical manufacturers such as Dow Chemical, etc. Now, if we look at the material standpoint, as the ICE industry migrates into the EV and as the EV industry grows overall, there will be a high demand for copper and lithium. These two are very critical in the production of EVs. There's been a lot of talk about lithium demand for the EV, but there hasn't been a lot of discussion about copper. And copper has grown in price significantly in the past year or two, by as much as I believe over 300%. In any case, another sector is the consumer discretionary, such as Wynn Resort, Tesla, Expedia, etc. These companies usually do well during inflation as they can pass on costs to their customers. Now, as for me, I'm looking into companies specific to the mining of copper and lithium. I'm looking into PLL, Piedmont Lithium, EUC or Uranium Energy, and several other stocks. I'm still performing my due diligence and will share with the Quantum Finance members in the Patreon page on the stocks that I plan to be buying. So there you have it. If you find the video of value and you have not already done so, please like and share the video. Please also hit the sub button and the alert bell. Thank you, and let's go make lots of moolah.